And we're back. So, Holy Macro Show is live today. Got a bunch of stuff to talk about. Now, when we're looking at these markets, there's so many things that have been happening lately, and everybody's focused on one thing or another thing, or it's the end of this, or it's the most craziest period you're ever going to have. It's either silver's going to 100 or it's going to zero. It's either the stock market's going to melt up into year end or it's going to crash tomorrow. This October is full of, and Kashab and I have seen this for years. Every single week, it's gonna be Black Monday on Monday, especially on the down Friday. So always be ready for those tweets to happen all October, every single year. That's probably the reason why we haven't seen too many October crashes anymore, because too many people are getting too bearish about it. And I think that there's reasons to feel these ways. I'm not saying the market's in a perfect condition. I'm not saying the market's going to go up forever. I am saying, like, sentiment wise, it looks like the market could go higher for now. Sentiment wise, it looks like a lot of things could go higher for now. And so we'll kind of go through that today. Talk a little bit about these markets. But first off, I wanted to talk a little bit about what we're doing with the Fed. They're pricing about 200 basis points of cuts at the moment, which is pretty wild to me. I'm always going to be on the side of the fact that we really shouldn't have cut rates at all. I really do think that. However, as a trader, it doesn't matter what I think. It just matters what's happening. So understanding that we shouldn't have cut rates is important, because if we shouldn't, what happens when they do and are? Well, that to me is the $1 million question, and it looks to me like more inflation will probably come into play. We talked about it before. Kashap and I, we had this conversation the last few weeks, actually probably a couple months, where they could come in and cut rates, and long bonds, let's say they catch a little rally and so on. I think that could happen. However, I do think it's going to turn over on its head at some point. I don't think the Fed has, enough juice to basically make this work the way they want it to work. I think long bonds are probably going to be held under. There's too much inflation out there. It's too sticky. It's under the surface. And I think the long bond is still telling us that. Short dated bonds, nothing wrong with buying them. You want to trade short dated bonds or something, great, especially if in futures. If you're a stock trader and you're buying the ETFs, you might as well just avoid it altogether. You're not going to make any money anyways. You want to put something like that in your portfolio to make a yield on it, fine. But at the same time, I think it's worth just kind of staying away from and looking at better opportunities. I think there's a lot better opportunities in the bond market at the moment. But I wrote about this yesterday, which is the fact that when we're looking at the divergence here, and TLT is lagging, and SHI, which is the 1 to 3 year Treasury bond ETF, basically the 2-year proxy, is leading. What that's kind of telling me, one, is we're still in the bull steepener trade, meaning that there's still liquidity coming into the market. So if there's a lot of liquidity out there and still coming into the market, that's going to be positive for stocks, mainly our cyclical trades, and really good for our commodity-based sectors like our steel stocks, copper stocks, and so on. Even aluminum stocks are starting to move. So I think that's going to be something that we'll continue to see. However, this lag here in TLT is telling me, like, there's something under the surface and pressure building, and as liquidity is loosening up, it's basically saying the thing that we've been talking about all year long is inflation's sticky. Some of the smartest minds in finance are also saying this same topic. The guys who actually traded through the 70s, 80s, and 90s, they're all talking the same way, which is, if we're looking at this, inflation is going to come back. Bond yields will probably be higher at some point, and commodities and real assets are probably the place to be. Kashop, so what are you thinking about the Fed right now? Liquidity? Are we in a situation where we're just going to keep melting up in some of these sectors, or do you think it's coming to an end a little bit sooner than later?
So I think the Fed, it's getting unpredictable. I totally agree with you that they shouldn't be cutting rates, but then it's all political now. So you never know what kind of pressure Powell is in. You never know what kind of pressure the other governors are in. So everyone focuses on Powell, but all you really need is 7 votes and
Oh, I think we
rocks
lost
already at
Kashop.
3. Sorry.
Can you guys still see Kashop?
I can I can see myself moving on screen.
Okay, you're good. You're back.
Oh, okay.
I
Okay.
don't know
Yeah.
what happened. Maybe it was me, but yeah, go
Okay.
ahead.
Yeah. So I was just saying that I can kind of tell the Fed is under pressure. They shouldn't be cutting rates, but they are because now Trump controls three of the governors. And even if Powell's opposed to cutting rates and he wants to do the right thing, all it really needs is four more votes. And with what happened with Liz Cook's case, and if any of the other governors have some skeletons in their closet, they are better off just going along with rate cuts than having the DOJ dig into their past. And now with all the surveillance and everything, you never know what anyone can turn up. So it's probably going to be a rate cutting cycle, and the Fed governors will be dragged kicking and screaming to cut rates. And I agree with the bond market that this is not good for bonds, because what's happening is you're going to see the Fed cut rates, and the debt is already at 38 trillion. It's going to keep going up, and you're going to see confidence evaporate in the dollar. So you're already seeing all these countries, they are moving away from the dollar for their trade. So India is buying Russian oil using UAE dirhams. And Kenya is telling China that it doesn't want to borrow money in dollars anymore. It wants to borrow money in RMB. And then you have Ghana saying that, they want to back their currency with gold, not exactly back it, but they want to buy all the gold from the mines and use that for trade, not dollars. So you already see these moves at the fringes. And then you see the Swiss franc, the way the Swiss franc is moving, it's like people have lost confidence in the dollar. And you go back to 1979, and there was a time where the US was forced to issue foreign debt denominated in Deutschmarks and Swiss francs because foreigners didn't want to lend to the US in dollars because they just know the Fed will keep printing it. So we are at that situation. The Fed is going to cut rates, inflation is probably going to skyrocket, and we are in for a world of hurt because you haven't seen stagflation since, well, the 70s, and now it's different because now everything moves at lightning speed. In the 70s, a bank run would take weeks because you had to queue up and you had to go to the teller, get your cash, and there's only so much cash that you can move in a day. And now bank runs happen over a weekend. Like we saw Silicon Valley Bank collapse over a weekend. So moves are going to be super fast, and I don't know how it's going to go, whether it's going to be crazy melt up, crazy meltdown. All I know is whichever way it starts going, it's going to be super fast. And with October ending, the chances of a meltdown are kind of decreasing, but then you never know in this market, instead of October being the month of crashes and bottoms, and you have done some research on this, you can talk about that. Maybe this time the trend changes, and this time the seasonality, which is typically very strong in the winter months going into spring, maybe that changes. I don't know. All I know is I really have to be prepared. I have to be alert, and I have to be okay with whichever way the market is going, because again, we are not going to get paid for trusting our opinions on the market, however good those opinions are. The market has to say yes, I agree with you, and only then we make money. So lot of conviction, but it's loosely held at this point because one Trump tweet, one Fed action, one little quake can just change everything. So I'm prepared for that.
Yeah, I think we were talking a little bit before we got on camera about 2018. We were talking about I still have the view, and this is mainly because I look at seasonality in a different way than most people would use it. I like to see, okay, if we're looking at this year, especially summer, we come out of May, everybody knows the phrase sell in May and go away. Basically, it was buy in May and stay. And so basically, you're buying in May. You made probably the most money you probably ever made in a summer as a trader. And so there was a lot of money that was made this summer. Very rare occurrence. And now we're getting into the end of the year, and I think that most of the time when we see strength in a period that should be bad, that tells us that the rest of the year will probably look in a similar way, where we'll probably continue to see strength. Now, this would be the biggest red flag for me. If we get into November, and let's say November is very flat, and then let's say December is also like flat to down, that would tell me a lot about what type of environment we're heading into. However, if we continue to stay in this everything goes up environment, which can't last forever, but it can last for a while. Um, I think that's kind of all systems go into the end of the year. And so I still think it's a bullish period until it proves otherwise. However, I know that there's a lot of pain under the surface still. And something we were talking about off mic was 2018. So Kashop and I were talking a lot in 2018 about the markets, and there was a lot going on. If you guys have traded that period or knew anything about that period, even if you look all the way to the left side of the chart, you'll see bonds bottom out. That was in 2018 where that bottoming period started to happen. And then we got into October, and well, let's talk actually that whole year. This is a much better one. Let's go start in 2017. 2017, we had the most lowest volatility period ever. Honestly, as a trader, it was boring. Everybody was like, "Oh my gosh, you probably made all the money in the world." And it was like, actually, like it was like that was really a thin rally at that time. There was more sectors than were going up as we get into 2018, but we'll talk about that. But it started to really thin out towards the end of the year, and this is kind of where the Mag 7, which back then we called them the FANG stocks, came in, where basically we had all of these, Microsoft, Apple, Facebook, Google, Netflix, Amazon. These all went up like crazy during that time, and they did very well. And then we got into January, and we had this crazy melt up period, and the next thing you know, we had a big crash, and this is called Volmageddon. So Volmageddon happened where everybody was plowing into shorting the, what was the name of that ETF for shorting the VIX back then?
XIV ETF.
Yes, the
That was a
XIV
Credit Suisse
ETF.
product. Yeah.
Yes. Oh my God. So yeah, everybody was plowing into this thing to make money. If you were a professional trader, you're basically selling calls on the VIX, and everybody was making money. Everybody was making a killing at the time. And then next thing you know, everybody was on one side of the boat. We get this huge crash, Volmageddon. The VIX spikes, basically takes all of them out. Shut down a lot of funds at the time. There was a lot of funds shorting volatility. And so all of those kind of went away. And then the market was in this very lull, boring period where nothing was happening for most of 2018. I want to say all the way from March through September. There was a rally, but it was very shallow, very slow. The fangs were kind of going up. And what you saw at that point was certain of these FANG stocks started to die out. So we got Facebook had crazy bad earnings, and then boom, they fell like 20% a day. And then it was, can't remember the exact order, but I remember all of them went, and the last one holding up was Apple. And then Apple finally went, and then the whole market went with it. So basically, this is the opposite scenario than we usually see. October all the way through December was the worst period of that year. So we had a 20% drawdown at the bottom, I think. Was that about right? I
Yeah.
think it's somewhere
Yeah.
around there. Yeah, 20%. And so it was a very volatile period. Finally Powell comes in and he goes, we're it was December, I think that was 11th. He goes, we're a long way from neutral. The market continues to crash. Nasty crash. And then all of a sudden he goes, we're neutral. And that was December 26, 2018. And the market bottoms out, starts moving up, and doesn't look back for most of 2019. So, what I'm saying here is, like to Kashop's point, anything can happen, right? If we look at these markets in a way that we go, I know that the seasonality is going to be good to year end, you're going to get hurt. What I'm saying is that's where the probabilities are. The highest probability bet is that the market continues to stay higher here to the end of the year. The other side of the bet is that nobody knows exactly what's going to happen, and the market is in a bit of some froth at the moment. We have a lot of people out there. I haven't seen any of these returns since. Actually, I was gonna say everybody's posting their returns. Actually, since the little bit of a drawdown that we had, I mean, what the S&P 500 had a 3% down day. Ever since that day, I haven't seen anybody sharing their returns. And that's just hilarious. But we saw a bunch of people sharing their returns. We've seen a lot of retail interest in the markets. We have seen some things that are kind of telling me that we're getting to a point where it's a little bit frothy. However, I'm not seeing the exact mania I'd like to see to really be bearish on this space just yet. And in Kishop, you and I know we've seen these cycles so many times, especially like it's either a big catalyst event that leads you into a massive drawdown, or it's everybody's way too heavy on one side of the boat. Towards the everybody's on one side of the boat, but I just don't see it yet. Are you seeing any crazier sentiment out there? Am I missing
So,
something?
so I think this, I'm not sure if this is confirmed or it's a rumor. There's going to be a 5x leveraged ETF on Nvidia. We are getting there.
Oh my
So
god.
there's now a 2x leveraged ETF on iron, which is kind of like a meme stock in the middle of Bitcoin mining and AI. So now, I mean, this whole single stock leveraged ETF mania, and now it's like 4x and 5x leveraged ETFs. I think we are starting to get there. I don't know why the SEC allows all these products, but they do. So, and then you have the betting sites, forecast event contracts. So I think we are starting to get there. I don't know how this will end though. I just don't know how this will end because we have never seen this level of financialization in history, and money is now moving at the click of a button. There are no more off days, nothing of that sort. So even on weekends, your banks work. Unless you're a big institution, you're going to be able to move your money around even on weekends. There's 24-hour liquidity, there's 24-hour trading. I don't know how this is going to go. All I know is the Tinder box is just accumulating more and more Tinder. And when does the match come in and set it ablaze? I don't know. Or does it just keep going to higher and higher levels of dry tinder? I don't know. But whatever it is, this is unsustainable. At some point, it will break, which is of no comfort if you're trying to trade it because it's like there's this joke, right? Show me a one-armed economist because he says on the one hand, on the other hand, and that doesn't help me. So it's kind of that situation, but we are helpless because there's really nothing we can tell. Right now, it looks like everything is okay, even though there are problems. And suddenly we'll be looking only at the problems and forget what I just said, that everything is okay. And then it just goes back and forth again until there's some clear cataclysmic event which just says, okay, this is it. The AI bubble is done. So AI is now responsible for 99% of US GDP growth. Without AI, GDP growth is at 0.1%. That's it. So it's become such a significant part of the US economy that all it takes is one hiccup in one sector to send the GDP lower. Now, Russia has oil and metals in a similar way, so lower oil prices will hurt their economy. Norway, again, same thing, it has oil and it is that exposed. The Middle East, same thing, oil, we are heavily exposed to oil. But this level of concentration hasn't been seen in the US since probably the dot-com bubble. Even during the subprime crisis, it wasn't this concentrated because you had home builders and you had banks, so you had all these other sectors which were kind of going along with it. Now it's just AI, so it's it's getting to a dangerous point. You don't know what the tipping point will be where it goes from danger to collapse. So that's really all I can say. Like, I don't know, and I think it's okay to admit you don't know and just trade what's in front of you and just wait for things to shape up.
Yeah, I think that's important. When we're looking at these markets, we have to always think of, what thinking around corners is important. But also trading what's in front of you is also the most important thing. Because I think it'd be easy for me to go, hey, we had a good year. I'm gonna pack it all in, and go take a vacation, be done with all this. And not saying anything wrong with that if you do that, but I don't think anybody should do that because they're making money. I think people should do that because you need a break at times. You might be having a bad trading period. You might be stressed out. There might be something personal in your life happening. These are reasons why you want to take these type of breaks, not just because, hey, I'm doing really well. So when we're looking at these markets too, the thing that I keep seeing and keep talking about is energy compared to TLT. Energy has really surprised me because I was sitting here going, if TLT catches a bid, at all, I think it would have, taken a lot out of XLE. Now, it has been, as TLT has been moving up, it has put some pressure on XLE in quite a bit. Um, but it seems like XLE is held up so well in this range, and that pullback wasn't that large. And so I'm still kind of looking at it and going, inflation's sticky. The Fed is trying to cut rates. Everybody thinks deflation is going to come into play at some point, or disinflation. I just think that we're still in a period of higher commodity prices. I mean, there's a reason why we're going out and trying to pick up any of these resource companies in the United States. Now they're going after quantum computing companies. Like there's a reason why we're doing these things. MP Materials and so on. Like we're buying these companies. We're buying lithium miners. Why are we doing this in the United States? Like this is very anti-American policy, actually. And the answer is we're doing this because we need the resources. The resources are getting very valuable. Not to mention, if you look at, we're talking about AI being such a large part of the GDP, and we're talking about the commodity cycle. We need more commodities. We need more of an ability to create more energy. And the way to do that is to by these uranium companies. And I think that or uranium, lithium, I could go on the whole list, but you guys know what I mean. Anything energy related, whether it's commodities, even silver is energy related, copper is energy related, palladium, platinum. Go down the list. You could just go down this entire list and go through them all. Coal. But there's a reason why these sectors are starting to hold up really well, and I think that that's going to continue. I think there's going to be a lot of money to be made here, but I think also you have to be really patient. Even $55 oil, like I kept telling people, everybody was like, oil's going to hit 50, and I'm like, look, if oil gets near $55, profitability for certain countries are going to come into play, like Saudi Arabia, and we're going to see that price pushed back up. And even we started heading that direction, and that price got pushed back up pretty quickly. Yes, you could say this event happened, or yes, Russian sanctions, or whatever you want to talk about. However, I will say that there's a bigger thing in play here, and that's the fact that they can't have $55 oil or $50 oil at the moment. It would be extremely undervalued compared to inflation, extremely undervalued compared to equities, and it would really hurt countries who are oil producing countries. So Kashap, what do you think about the energy sector? You finding any value out there? Anything that we should be looking out for and putting on our radar?
So to add to your point, I would say the only way we can get $50 oil or $40 oil is if we are confirmed that the US is headed to a recession. It is that is the only scenario where 40-50 oil makes sense. And even there, because it would be a stagflationary recession, I'm not sure oil can stay at those levels. Broadly, in terms of energy, yes, I like the price action. I like how oil has gone up above 60 now. So I thought for sure it was going to keep heading lower and it was going to signal a recession, which is what gasoline was signaling. And then here we see three sudden big moves up in oil, and same with natural gas, back above 3.3. So kind of really tough to call. This could just be counter positioning and we are headed to a recession, or this is just another indicator that the melt up is going to continue. So I don't know. So I do have oil stocks on my list, and I have written a report, and I'm almost ready to pull the trigger on one particular stock. But right now, I don't really have any position in oil, but I'm really, really tempted.
Yeah, I think it's a good idea to sit out at the moment. It's a there's a couple we have a couple stocks, mainly some international names. But now when I'm looking at this, it's more of a I know, you feel like you know that something's going to happen, but you never know because there is the other side of it, which is exactly what you said, which is if a recession came into play, it will show up in oil first. Oil will start to break down. It doesn't matter what any country wants or anything, and oil will be the leading indicator. It's one of my favorite leading indicators for everything. Not because it's always like, it has to go up or down perfectly, but when it starts to break major levels or just start breaking down like crazy before everything else, It's telling you something. COVID, I think, my signal to short energy was way before the shutdowns. I mean, that would have been in January. Um, I remember we had a false breakout signal. There was something that happened with Saudi Arabia. I can't remember what exactly happened. That was December 2019, and we hit a new high in oil.
The Houthis struck one of the Aramco refineries, and there was a spike. You and I were talking about it. You went and filled up your gas tank. I did the
Yeah,
same.
yeah,
Yeah.
yeah, yeah, yeah. So like we get this massive breakout, and it's a 2B reversal pattern. It's a old Trader Vic trading pattern, meaning we got a breakout reversed. We call it an oops pattern now, a bunch of different words, but it's originally called a 2B pattern. So we broke out, closed below. I think that at the time, I think that range is between what 40 and 60. I mean, it was a long range for all of 2019. Can't remember the exact number. You guys can check the math on that. But we broke out, broke back down, and then we continued lower. And then I remember breaking 50, and that's where my signal to short kind of came in. And then we just kind of continued to break down over and over and over again, getting below 40, getting below 30. And then we shut down the economy. So you're going to see that a lot of the time, which oil is going to tell you things. However, at that time, the whole energy sector looked exactly the same. And so right now we're not seeing the energy sector really break down in the same way oil is. Back then we did. We saw the energy sector all the way back here, actually. If you look at it on this, you can see it on this chart. It broke down heavily, very quickly, and in a big way. So that was something that, is significantly different from today. Now we're seeing actually a divergence between oil and the energy sector. Now the energy sector is kind of moving higher while oil is moving lower. Very interesting. Just something to keep on everybody's radar. Because I think if we're seeing the energy sector really break down in this type of environment with inflation sticky, with all of these sectors moving, with a rush to find more energy out there, I think we are headed into something nasty. I think that's a good way of looking at it. But looking at this chart, we're looking at bonds over here on the right, which is in blue. We've got gold up here. Gold is what massively outperforming everything lately, and that's very obvious. But also the New York Stock Exchange is outperforming commodities. Bonds really can't catch a bid against commodities just yet. So I do think this is going to continue. I think not all of this, but I think that this outperformance in commodities compared to bonds will probably continue for a long time. I do think that's someplace we want to be. I think the idea of portfolios now, it's kind of interesting to hear, things we've been talking about for years, which is I'd rather be in, a 60-40 with 40% gold than 40% bonds. Like Kashap and I have been talking about that for years. Now it's like what Morgan Stanley wrote a note on it recently. B of A wrote a note on it recently. So we're seeing these big banks start writing notes on these facts right now, which I don't like for our trades, but I do think it's the right idea. Like it's the right idea, and I don't like it because of sentiment. I don't like. I really like to be in trades where everybody hates the trades I'm in. That's my favorite type of trades. Most of the time, those work out well when everybody starts to get interested and like Morgan Stanley's agreeing with me, that makes people feel good. However, for the account, it's not going to exactly do that. You're not going to probably see this crazy melt up period again in gold. I think gold still could go higher here. I think it's going to trend. However, these 3% up days and huge moves and the craziest months ever in gold, those might come to an end if we keep seeing more institutions interested in it.
So
and
interesting thing
Go
about
ahead.
the gold move. So in April, long gold was cited as the most crowded trade in surveys. And what happened next? 3 months of sideways action. And then everybody gave up on gold. It's not trending, it's going sideways, it's boring, it's a pet rock, blah, blah,
Yep.
blah. And then what happened? Straight up parabolic. And then it has a small dip, and everyone's like, oh, gold is dead. Like, you kind of want to be in gold when you see this price action because, well, no one can take that period of where it does nothing. 3 months of gold doing nothing while everything else is moving, people sell their gold. And you and I, we will stay in this trade for a long time because we know exactly what gold is. we have been in it for a long time, and we'll probably be gold bugs until the day we die. So for us, it's different, whereas for other people, it's different. And I'm sure it's the same for you for whatever the trend is. If it's cocoa, orange juice, doesn't matter. You can sit through 3, 4 months of it going sideways. Most people can't, and that's really the secret of outperformance. So the if you had to catch this move in gold, which happened in September and October, you had to sit through that sideways period. And that's really, I think, the key. That's something that people miss. It's not just about chasing trends or chasing momentum, it's being able to sit through sideways price action.
Yes, and so I mean, and it's also interesting, and we could talk about this a little bit, which is I probably have one asset in the entire world that I actually hold on to, and that's gold. I thought this was kind of funny, Kashop, because people have been writing me like, "Oh, I bought gold at," and it's funny. It's just like one, it's just telling me I'm getting kind of old, but it's people are like, "I bought gold at 2,500, and I just kind of want to sell a piece of my physical just to say I did it." And like, I had a buddy tell me that just yesterday, and I was like, man, that's funny. And I have a bunch of people talking about like I bought silver at 25. I did this at this, and it's like because Shop and I have been buying this thing like when it was down at $1,000, like we were buying, we were very interested. When I was a kid, I picked some silver up for I think at the time it was like $3 an ounce. Obviously I'm a kid, I'm too young to really make sense of it, but once again, it's like these prices were out there for everybody to pick up for a long time and just nobody cared about it. And now it's something that more people care about. I'm glad, people are getting interested. But it's the one asset that like over the years, people like Kashop and I have accumulated, put away, stored away for a long time. And for me, it's something that I'd like to have for, it is my retirement. It is my thing to hand down to children. I could go on a list about all of the different ways I think about gold. However, at the end of the day, it's like something that's tangible. It's where if everything goes to shit, I know I have that gold and silver. There, and that's a possibility. I mean, if you were sitting through COVID was so like traumatic, and like as a trader, not saying like it was like going to war or anything. It's nothing terrible, but it was traumatic in the sense of there was days where the market would crash so quickly back to back, and we're talking like this isn't like a 1987 market. We're talking about trillions and trillions of dollars in this market today. And we'd have a 10% down day, and we'd wake up to another 10% down day, and wake up to another 10% down day. And maybe you were short, maybe you were making money. We were shorting a lot of these things. We were making some money, but at the same time, I remember thinking, am I ever gonna see this money? Like is this whole system gonna collapse and that's gonna be the end of it? And maybe that's like pretty wild thinking, but at the time, like I feel like anybody who traded through that period felt that because it was very traumatic. Um, but now, kind of getting to where we're at today, it's like I think that you have to understand if you have those periods as a trader, how do you feel good about it? Well, I know I have gold, I know I have silver, I don't know what can happen to the dollar. I think the dollar would have been fine in that scenario, but once again, you just never know. So gold, silver, I know it's there, I know it's tangible, I know I can always get something for it, even when the prices collapsed. And this was an interesting thing, and I'm sure you know this, Kashop. I'll just tell the viewers when silver collapsed, I think it was under $10 in 2020. The premiums of it, if you wanted to buy physical, it was still like $16, $17. Like so spot went all the way down to 10. The premiums were so high that you were paying about 50% premiums, which is crazy. So once again, it's like that thing has value. You know that you're going to be able to sell it for something, which is the reason why I have it. I hold it. I think it's something to hold on long term. Speaking of which, we did get some comments on the dollar. So I wanted Paris and me were kind of going back and forth. I wanted to bring this up. He explained himself a little further. So my thesis is that the dollar will weaken until Europe and Japanese financial systems collapse because they're in a worse state, in my opinion. Then people will flock to the dollar again, albeit for a short while. And then he also said, because I mentioned, why would collapsing currencies make the dollar fail? And he said, no, the dollar will continue the current trend of weakening, But when Europe and Japan financial systems start to get into real trouble, people will start again to flock to US dollar for a while. So, Kashop, do you have any thoughts on that? Because I have a lot of thoughts on the dollar at the moment, but it's a global currency war. Like that's the thing that you always have to keep in mind. Like it's not the dollar has to do this or the yen has to do this. It's the dollar is just a basket. At least the dollar index is just a basket of currencies. And if it's a race to the bottom, who knows exactly who's going to hit the bottom first? So, Kashop, do you have any thoughts on that?
So the dollar does get a safe haven bid, but it happens when there is rising panic in the market. So if you have some kind of event that makes investors panic over a duration of weeks, then yes, the dollar becomes a safe haven. If it is kind of a known factor affecting markets and it takes place over months, then I don't think the dollar gets a safe haven bid. So dollar responds to panic rather than a terrible situation that is known and which is starting to get priced in. So for instance, COVID, yes, absolutely everyone flocks to dollars. Or you have a debt default in say Latin America or Southeast Asia or Russia or any of those scenarios, yes, people panic into dollars. But let's say you have this situation where, for instance, tariffs kick in, trade grinds to a halt, and everyone knows trade is going to be bad for the next 3.5 years. No, the dollar doesn't get a bid in that situation. So I think it all depends on what the move is and how quickly or slowly that move happens. So my thesis is slower moves dollar doesn't get a safe haven bid. Faster moves, yes, it temporarily does, but then it goes on to resume its downtrend. So if Europe, let's say the euro or the yen, they have a prolonged drawdown, they have a prolonged collapse. So look at Brazilian real. So the real probably peaked sometime around 2011, and then it's been just declining, declining, declining. Does that affect the dollar? I think not. Whereas you have a situation, I don't know what was it like, I don't think we have had a situation where the dollar got a safe haven in a long time, except for COVID. In that situation, yes. Or look at the Swiss franc right now. Ever since Trump came to power, the Swiss franc has been steadily gaining value. So that's a trend. So that is a trend that would probably continue regardless of what happens to the euro or the yen or the dollar. I don't think the dollar will ever be in the position of the Swiss franc, except for very, very teeny tiny bursts of extreme fear.
Yeah, I think so too. If you if you look at history, it kind of tells you this. And I always call the dollar the panic currency because basically when people panic, they run to dollars. You watched it happen in 2008. Wrong environment for it to really be sustainable at that time, but you saw those two big spikes I think happened in '08 and maybe another maybe 2009 or 10, right before the dollar bottomed. And so most of the time you'll see these big spikes, and most of the time it's also to do with a bear flattener trade, meaning the yield curve is flattening out, going from a bull steepener, which we're in today, which is putting pressure on the dollar, meaning more liquidity going into the market, and then basically the 2-year will start to go down faster than the 30-year, and that leads to the bear flattener trade, which is liquidity tightening. That liquidity tightening is a good environment for the dollar. We're not in that environment today. We're in a bull steepener. Liquidity is getting looser out there. We're having as many rate. This is wild to me. As many rate cuts as we had during COVID or 2008. Right now, currently, I mean, like it's wild, and it's kind of like any way you look at it, we're building to this either a crazy melt up period or saving us from some sort of recession type of move, because it's just none of this makes sense at the moment. It doesn't make sense to start cutting rates in a cycle where markets are just continuing to melt up. I mean, it'd kind of be like if you looked at it historically pre 2020 and you looked at the market and you were like, okay, when does the Fed cut rates? And you were like, okay, well, it's certainly not when we're hitting new highs. It's certainly not when gold is at $4,500. It's certainly not when all these commodities and cyclical stocks are moving up like crazy. It's certainly not when the AI boom is wild, and speculative growth is just moving up like crazy. It's certainly not when international stocks are all ripping to the upsides and making new highs that they haven't made in many years. I mean, you could say that all pre 2020. After 2020, now it's kind of a, well, we just kind of cut rates whenever we feel like we need to. I know there's a lot of debt out there. That's also part of the issue that, they're not going to say is, hey, we also have a lot of pressure because of the debt. There's also the political pressure going on right now. But mainly to me, my main thought about all of it is this is an environment that kills the dollar in the short term. I don't know. I'm not saying like dollar collapse is the end of the dollar. I'm saying the environment we're in will kill the dollar. Like it's not going to stay strong in this type of environment. We're going to probably continue to see this melt up in the energies. Yes, oil hasn't joined the party, which is what everybody thinks of when I talk about energy, but also we're looking at uranium, coal, all these things are already moving, lithium miners. These things are moving quite a bit. Even solar stocks are moving like crazy. So we're seeing a lot of these moves already starting to happen. And I think that's probably going to continue as long as we're in this boat where we're going, okay, we need to cut rates into whatever cycle we're in. We don't care what cycle we're in. We don't, I mean, really, they always say they don't care about the stock market. And that's been proven not to be true many times. But it really seems like they don't care that the stock market is just ripping to the upside. Speaking about ripping and possible reversals, let's talk about this one, Kashop. So small cap index, I always use the S&P 600. A lot of people have been asking me, hey, this made a double top in the Russell. Why don't you use the Russell? I don't use the Russell because it's a bunch of shit in there. Like the Russell is garbage. The small cap 600, at least these are companies that most of them have earnings. They're pretty legit. So it's a little bit different. So I always use the 600 index. I think it makes more sense. But looking at this here, I'm kind of seeing a point where, and not to mention we're in small cap seasons. We finally have seen IWM make some new highs. The small index is also doing well. Micro caps are doing really well. So I guess the question is like, what do you think about small caps? We don't have to talk about it at index level. We could talk about the stocks, the sectors, and so on. I think it's looking really interesting here. And if you remember, I'm sure you do, but our audience, if you guys remember, back here, actually, we saw this massive move into that sector, into small caps, into micro caps, into gold miners, into copper stocks. Energy started to pick up around 01, 02. So what are you thinking about the small cap sector? Do you think there's some value there? Think there's some places where people want to start checking out?
So, the one thing that the AI bulls say, which I agree with, is that all this capex is being financed by companies which don't have a lot of debt. Now, if you remove Oracle from the mix, then all these companies are cash rich, meaning when the Fed has rates at 4.5%, 5%, they are making money on the cash they have on their balance sheet. Whereas if you look at the small caps, it's the opposite. The small caps have a lot of debt. So they were really hurting when the Fed was hiking rates, when the Fed was maintaining rates at a high level. And now, even though the bond market is kind of not doing so well, they have an opportunity to refinance their debt. They have an opportunity to lower their cost of capital. So this is really beneficial for the small caps. And simultaneously, when you see the Fed cutting rates, the cash on Apple's balance sheet isn't earning as much interest as it used to. So that's a hit for the large caps and it's a boon for the small caps. So I think if we get rate cuts, we should start to see the small caps start to do well. Now, of course, the flip side of it is that the AI stocks, it doesn't matter what happens to the economy, it's just a bubble, it keeps going. Whereas if you're a small cap investor, you're pretty much looking at fundamentals. So if you're, let's say, you're picking up a home builder, you want to look at what's happening to housing starts. You want to look at where mortgage rates are, where housing affordability. So you start looking at all these fundamental factors, and then you're like, even though their cost of capital is decreasing, their debt burden is decreasing, maybe I don't want to touch home builders. And then you just keep going sector by sector, and you're like, I don't know, because there's a lot of uncertainty. So there's this uncertainty discount to these small cap stocks. Now we need to see all of this disappear for small caps to do really well. That doesn't mean you cannot pick sectors within small caps where things can actually pick up now. So for instance, biotechs. Biotechs, I ran a study like I think 2 years ago where a lot of these stocks were net stocks, meaning they were trading below the net cash that they had on their balance sheet after you subtract all their liabilities, which means if you liquidate the company, you get more cash out than what the market cap is. So you have these crazy deals in the biotech space and no one wants to touch them. Why? Because there's uncertainty. So some of these sectors would probably start to get repriced. I don't know what these sectors are. Maybe it's biotech, maybe it's oil service companies. So interesting thing is oil isn't doing so well, but oil service stocks are actually doing okay right now. And this was the same thing that we saw in 2023, I think. So 2023 from May to September, overall market was kind of flat. Oil services stocks really took off. So you could have, I mean, if you really know which sectors you're diving into, you can find such bargains in small caps. But right now it's a tough trade. And I would rather look at small caps on Hong Kong or Chinese small caps or small caps in other countries than US right now because US has a lot of uncertainty. But if you're an active stock picker, I think it's a great time for you to go in there and pick those stocks.
Yes, I think there's so much out there right now, that you can basically find these different sectors, these smaller sectors that are outside of the S&P 500, smaller stocks outside of the S&P 500, and probably massively outperform the S&P 500, which guess what? That's our goal as traders. Our goal as traders isn't to perform in line with the S&P 500. If we want to do that, I'd make my life a lot easier. I'd put all my money in an index fund and I would go to the beach. That'd be about it. But today, I'm still trying to outperform the market. I'm still doing so. So I'm going to continue to try to find these areas of value. So we only have a few minutes left. Wanted to highlight this one. It's another thing I'm just saying the market looks like it has some more upside to go. We're still seeing the relative strength in semiconductors. Semiconductors for me is one of the biggest warning signs. If this market's going to roll over, we're going to start to see semiconductors roll over as well. So semiconductors are holding up, and for now, as long as those are holding up, I'm going to stay pretty bullish on this market. Next chart is the NASDAQ or the NYSE advanced decline line. Similar thing. We're seeing this holding into a bullish trend, short term and long term. So overall, I'm just saying the market looks good. Everything's still kind of sustaining the right way, and that'll probably continue. All right, guys, I gotta get going. Kashop, you got anything to end on?
No, I think this is perfect. We can end here. Yeah. Thanks everyone. Thanks, Jason.
All right, guys, we'll see you.